There you go.
Warm welcome to everyone joining us today. This is our daily growth webinar on digital health funding strength. Titled "A Storm is Brewing." We look forward to telling you more about that subject in just a few minutes. We're going to wait for everyone to join us, and then we'll continue with the webinar. All right, Julian, it looks like we have people coming in. We're going to go ahead and get started. We don't want to be late. Again, warm welcome to everyone joining us this afternoon. Julian and myself, my name is Sarah Schmachtenberg. I'm head of data and analytics for Galen Growth. I'm located in Basel, Switzerland. That's our European office. Galen Growth serves its clients from 3 offices across the globe. There's the one in Singapore. For our Asia Pacific clients, our European office in Basel, and we also have an office in Chicago in the United States. So nice to have you here today. Galen Growth is the preferred digital health innovation partner for clients across the globe. Our clients we're serving include pharmaceutical companies, biotech, and insurance companies. We serve consulting companies and other investors across the globe. Our product is Health Tech Alpha. It's the world's leading digital health private market data, intel, and insights platform to industry, investors, and startups. Health Tech Alpha is superior to any of the other data intelligence platforms for digital health. We have more data than anyone else, including over 14,000 digital health ventures that we have cataloged and easily searchable for those looking to partner or understand the digital health environment. Health Tech Alpha includes best-in-class taxonomy and tagging, as well as better research results than Google. And we're going to go into Health Tech Alpha a little bit later, and then I can show you some of that as we go along. In addition to Health Tech Alpha, we have an unmatched expert teams. We are all experts in digital health at Galen Growth to help you understand and get the most out of your data platform. Health Tech Alpha powers our thematic research that we do. You can go to Galen Growth's research page. We use our research to help our Fortune 500 advisory work, and that all is powered by Health Tech Alpha. So today's topic is on digital health funding strength, titled "A Storm is Brewing." This is a Q1 2023 report. It's a report that we do intend to repeat on a quarterly basis to keep you up to date and help you understand how digital health is managing to get through the funding drought that we're in. The funding strength webinar is a deep dive into the digital health space and the funding squeeze. It takes a global look at what's going on and what's perhaps not going on in funding. Julian will tell you a little bit more about that. And then we do lower that from the global stage onto the different funding regions, the major funding regions for digital health. We ask that if you have questions, please feel free to ask those questions. Use the Q&A function within Zoom. Then we can get to the questions and either answer them live or help answer those before we get too far into the webinar. Okay, so at this point, I'd like to introduce Julian. Welcome to the webinar, and thank you for talking about this very important topic, very topical discussion we'll have today. We're happy to have you here. And what can you tell us about funding strength? Because as far as I know, only 18 months ago, life was good in digital health. Nobody was worried at all. Venture capital was flowing. We did have a global pandemic, but at least we had venture capital. What happened?
Yeah, how things have changed, in the last 18 months, absolutely. Quick note, we love your questions, guys, so please use the Q&A function on your screens to ask questions, and we'll endeavor to answer them live. If not, we'll certainly answer them at the end if we don't get to them live. Yes, you're absolutely right, Sarah, and everybody I think gets a sense from me anyway that I much prefer talking about some of the other key drivers of digital health scaling and maturing, other than funding. But funding is one of the core ingredients to the vibrancy of innovation in healthcare, and more specifically, of course, innovation in digital health. But you're right, 2021 saw us as record highs. We closed at 55 billion worldwide of venture capital funding. That's just the funding, ignoring all the other deals that went on. And of course, it was pretty much an environment, as you put it, Sarah, where practically any digital venture really was a great story, could collect funding. And so, that was fantastic. The gravy train was running along full speed. Some people describe it as one of the COVID dividends, along, I guess, with hybrid working. And so things were going well until the first early signs of a bit of a slowdown coming along, with in November 21, of course, interest rates starting to go up, to recognize the fact that inflation was starting to tick upwards. Now, 22, I think everyone entered 22 cautiously, but thinking, okay, well, things will be okay. And we started continuing, certainly seeing more funding in 2022 Q1. Q1, in fact, in 2022 was very strong. But we continued seeing interest rates driven by inflation. The geopolitical turbulence started picking up, of course, with the invasion of Ukraine. And so all that amounted to quite a lot of economic uncertainty. Now, not teaching anything new to anyone on this call, but all these things were certainly reflected in the fact that the IPO market, for digital health, but of course other sectors, essentially was dead and has been dead for 2 years. What does that mean? That means it has a knock-on effect back up the VC supply chain, or the VC sausage machine. If there's no exit at the late stage end, then that has a knock-on effect eventually all the way up the VC sausage machine up to the early stage level. So that was 22. 23, we all expected more of 2022, but we didn't quite expect what we did get. Silicon Valley banks collapsed. I think that was a major sign that things were not all well in the financial sector. And let's not forget, Silicon Valley Bank was a reasonably prolific investor in digital health, as well as, of course, being the banker of a lot of digital ventures and of venture capital firms. We do touch on Silicon Valley Bank in the analysis in this report. I don't really expect us to get into any depth today on Silicon Valley Bank, but we do recommend people see our snapshot of Silicon Valley Bank as an investor in digital health. And for those who want even more detail, please step into Healthtech Alpha and look at Silicon Valley Bank's portfolio in a bit more detail. Then we had the Pear Therapeutics bankruptcy. Now that's a US bankruptcy, it's Chapter 11. So we shall see some of that great technology reappear. But then everybody thought Pear Therapeutics, everything was going very well for it. Its clinical evidence was clear, its leadership team were certainly very strong. Funding seemed to be, certainly had been very much its friend. And so what did go wrong? But wrong enough for it to hit the skids. So those were the telltale signs. What was happening in the background? Well, we saw limited partners. So those are the people who invest in venture capital firms started to withdraw funds in order to allocate them elsewhere, for example, private equity. And we're starting to see private equity step into digital health to start making acquisitions. In other words, delist some of the digital ventures that did list. For example, some headlines this morning about Babylon looking to go private again, having only listed last year through a SPAC. So watch this space. There'll be a lot more of that type of activity going forwards. We're also seeing the same limiting partners asking from the venture capital firms that they put money in for some cash returns. So that, of course, as you can imagine, is creating liquidity issues for venture capital firms. And many of them are, for example, at the moment in the Middle East, courting the very sovereign wealth funds to replenish their own funds, so as to be able to continue, I guess, shoring up their existing portfolios. But we're also seeing a slowdown in terms of asset exchanges between VC firms, for example. And a lot of that is driven by the fact that valuations are an absolute nightmare. No one can agree. You get the A16Zs of this world that are coming out of very high valuations because they believe that they are A16Z and therefore they have greater brand equity in the market. But it's not really holding out. You know, it's difficult to put a finger on valuations, but we're certainly seeing late stage valuations cut by half. Growth stage is not far behind, but the only silver lining really is early stage, so up to and including Series A, is still maintaining some strength in valuations. But we'll see what that means for funding as we go forwards. All of that means that Q1 rounded off at about just south of $5 billion of venture capital funding deployed. So that's just venture capital funding, which is barely 1/3 of what Q1 in 2021 was. So what does that mean? Well, it means that a lot of ventures which did raise in the last 18 months are going to start running out of runway, funding runway. You know, the typical runway for a venture capital firm, for a digital health venture firm, or for that matter, most tech startups who have raised, is about 18 months to 2 years. So anyone who did not raise in the last 18 months is starting to run on not quite fumes, but it can't be far off fumes. So unless they've got a very strong revenue line, they have a headache on their hands as we look forward. So we know this. A lot of the ventures we talk to are cost cutting. A lot of the ventures we're talking to are looking to restructure or certainly reconsidering their business model with a view to restructuring towards it. And of course, as Sarah has pointed out in previous analyst briefings, we're seeing a very strong M&A market, venture to venture M&A market, and we expect that to continue strengthening throughout the rest of this year. But what we wanted to do with this report, with all of that context, is really drill into what is that funding strength? Because we heard a lot of talk and noise and fanfare about all the funding that was going into the system, but we seem to be watching a very quiet environment when it comes to what is the status of funding in digital health, and of course, what is the outlook look like. Now, Timo quickly has asked a question about why I was on the first slide. That's quite deliberate because I wanted to give the context to get to the next slide, but thanks for telling us, Timo. Just in case you're right, we may have fallen asleep on the button, but we haven't, I promise. So anyway, so that's the context for you. So the purpose of this is to look at funding strength, or more specifically, what stress exists in the system. And so we look at that very carefully. We have been monitoring it for a while. We decided to start sharing that with the broader audience. And Sarah will spend a little bit of time today showing you how you find that in Health Tech Alpha. So let's certainly hop on to the first slide so that everybody doesn't think that our machine is stuck. So if we look at the first slide, there we go. Thank you very much, Sarah. So Sarah will touch on the methodology. So just hold the questions in terms of methodology until a few slides from now. But just look at the numbers at the moment. So what we're looking essentially at here is what percentage of ventures, it's normalized, but I'll let Sarah talk about that. What percentage of ventures have actually raised in the last 18 months? And therefore, what's that as a percentage of the overall ecosystem? And therefore, where does that mean a particular ecosystem sits? If you range it between 0, nobody's raised money at all, which is a nightmare, super stress, to 100% everybody's raised, and therefore everything is hunky-dory. Now, we don't expect us to ever hit 0 or 100, but certainly we expect the little black bubble on the left-hand side of your screens to move up and down. And of course, for the last 18 months, it has steadily moved up towards the red. So we're assessing the stress level, so to speak, in digital health across the globe at 38%, or more specifically medium high if you use our little barometer on the left-hand side. And we'll get back into how we get to that in a minute. So that's an overall number. If we very quickly drill into North America, you'll see it's slightly happier story because technically speaking, we're about 50-50. So that's more towards the medium stage, which is not too bad, bearing in mind the amount of stress that exists in the contextual environment around the ecosystems, such as geopolitical, such as economic. But let's see what happens as we go forwards, of course, because the US general election will get underway in Q4 this year. We're already hearing various issues around debt ceilings in the US and the renewing of debt ceilings, etc. So let's just see what that means in terms of causing domestic turbulence within the US market. No questions yet, so let's move on to the next slide, which Sarah will narrate for us.
Okay. I'm going to jump in, Julian, and talk a little bit about the methodology behind this, and then you can help us understand what's going on here in this particular slide. So when we look at funding strength, right, what we've done here is we've taken all of the digital health private ventures across the globe, of course, split them into regions as you saw, and within those regions, we can understand which of those ventures have raised funds in the past 12 months, 18 months, 24 months, and how many have not, right? We are putting a little caveat and saying some ventures we're very much aware are bootstrapped, so they will never raise or publicly announce a funding raise. We've taken those out of the equation just so we don't have any sort of skew. So we're really looking at any ventures that have announced a funding raise after 2012 and looking at those, because we say those are the representative population here for this particular analysis, right? So looking at getting specific here, if we look at the numbers, North America, for example, if we look back at Q3 2022, what was the status at Q3 to 2022, right? At that point, right, 18 months prior to that, you have 2021, Q1 2021. We're looking between, and at any ventures that have not raised funding, or sorry, that have raised funding between Q1 2021 and Q3 2022. And we can say, okay, they have that 18-month runway, right? If they've raised funding, 58% of them have raised funding in that period of time. So those ventures have enough funding in their back pocket, more or less, to continue operations as normal, right? Here for North America, for the 42% that didn't raise in the last 18 months, then they're starting to get to a more critical situation where they need to raise funding, right? So that's what we're talking about here. We have 58%. We took that same snapshot at the year end, right? And we're seeing, okay, fewer and fewer ventures have been able to raise in the past 18 months. And then now at Q1 2023, these are the numbers that we're reporting on now. So you see over the past 6 months, right, the situation is becoming more critical because at this point, only 48% of North American ventures have been able to raise in the last 18 months, right? So that's the methodology we use behind the report. And Julian, perhaps do you want to say anything about here the situation? What's the difference between North America, Europe, Asia Pacific? Why do the numbers look so different?
Well, yeah, I mean, listen, everyone will have their point of view on why there are differences. Ecosystem sizes are very different. The US is substantially larger than Europe and certainly Asia Pac these days. Risk appetite is very different. The amount of funding available and capital available in the US is very much larger. So these are factors that are certainly contributing to why the US is presenting a slightly happier picture, let's say, in terms of level of funding strength or stress, whichever way you look at it. And then, of course, you get to Europe or Asia Pacific. Asia Pacific issue is really largely driven by the fact that China has traditionally been, 80% of total funding deployed into digital health over the last few years. And of course, China, since COVID, has been in a lockdown, which means that investment in and out has been minuscule, verging onto nil. Europe's interesting. Europe has its national champions that are continuing to invest. If you look at BPI France, they've invested 12 times in digital health in the last 12 months. So they're certainly continuing their mandate of supporting French digital innovation. But the venture capital environment in Europe is subscale for the size of the ecosystem in terms of number of ventures and for the level of innovation and the quality of talent. And in fact, if you look at specialist digital health funds in Europe, those are even more subscale in terms of the sheer number of them that exist. I am expecting that trend to continue in its downward trend, whichever one of those ecosystems you look at. And we'll see whether Asia plateaus or bottoms out, because China comes back online, fingers crossed. But Europe at this stage, I'm concerned.
Yeah, let's look at Europe in detail.
Yeah.
We can jump to that slide. For those of you here, this is the Europe focused webinar. We do have data on the global and the North American ecosystems more in detail, but looking at Europe with the same lens that we were just talking about. What's really shocking here is looking at, for example, the early stage ventures compared to the growth stage, late stage, right? The numbers that we've been showing are the volume weighted average across all of the venture stages, right? If we look at all the ventures, then we can take that volume weighted average versus the numbers that you see in the yellow are the Series B and Series C numbers. So, Julian, why do we have to be worried about the European ventures in particular?
I worry about them largely because Europe, despite its size geographically and its size from a healthcare spend perspective and its size as a population, cumulative across Europe as a whole, I'm not talking EU, I'm talking Europe as a whole here, it just doesn't have the scale of, I guess, the venture investing that the US has. And in view of the fact it was already less abundant in the good days, and it is downward trending towards what I would say, 1/3 having not raised funding in the last 18 months. My concern is that we will see an increasing number of ventures having to find somewhere else to get tucked into, or potentially hitting the wall. And the problem with Europe when it comes to bankruptcies, when you're bankrupt, you're dead in the water. It's not like the US where you can, like the phoenix, re-emerge from the ashes.
And what do the ventures need to survive? Are there key items or something they can do to become more attractive to the venture capitalists?
Yeah, and I hope many of them have been addressing what I'm about to say some time ago, rather than embarking on this journey now. Cost cutting, it's got to be, growth at any cost is gone. That's no longer even a conversation point. And so really it's about cost cutting and narrowing it right down to what is core to the business to deliver the promise rather than nice to have. And I'm hoping that's been going for a while now. Proof points. You've got to get on with proof points. If you've got them, great, make a large amount of noise about them. And by proof points, I mean clinical evidence, if it's relevant to you. If you're a wellness B2C, good luck. That's going to be tough. But if you're a DTX stroke patient solution where there is a need for clinical evidence, make absolutely sure you've got clinical evidence that is relevant to the market you're in. So if you're in Europe, CE marks, guys. And of course, the other is reimbursement pathways. If you haven't got them already, figure out how you get into them. Digas of this world are an example, but they're not your solution. It's not a panacea to your challenges. Diga is one framework, but there are others around Europe. Some of them are new and just getting off the ground. Some of them are a bit more established. But as we know, looking at the Diga history, the greatest challenge is getting physicians to prescribe so as to get reimbursed. So be aware that that is not a short-term solution to revenue line. But importantly, focus. Now's the time to really understand who's out there is going to help you scale, who's out there is likely to invest, and therefore, I know it's sounding like helping myself on here or helping getting growth here, but you need data, guys. You need to understand who's partnering, and partnerships are still in growth mode, and Sarah can touch on that. But also who's investing. Not everyone's not investing, but they're certainly being very cautious of where they're investing, and so figure out who is investing, or who has traditionally invested in your space, and therefore approaching them on a very clear basis, such as proof points, etc.
Yeah, that's a very good point, Julian. Now you mentioned Health Tech Alpha. I do want to go into Health Tech Alpha briefly and show us here what you can do, what kind of data we have that can help out with that search. So I'm going to flip over. Julian, you see that I'm flipping over to Health Tech Alpha?
Yep, it's on the screen.
Okay.
So it's great to show people how you quickly understand who's been funded and who hasn't.
Yeah, usually we go into Health Tech Alpha to look at taxonomy, right? Look at categories, look at evidence, look at all this stuff. Today we're going to focus on funding, and we can go then into those funding transactions that have happened. Now I've already filtered here for Europe, so we're looking at essentially 3,682 funding transactions that have happened since 2012, more or less. If we want to focus on, for example, the last 6 months, then we can certainly filter and say, hey, what's going on the last 6 months? I'm going to go over to November 2022 and apply these filters. And what you see then is that our number of transactions has decreased. There are only 127 funding transactions since in the last 6 months, right? So it's really kind of startling what's been going on and what the data tells you when you look into that in detail. Now, to get more information, let's help jump into let's see, a good one. Let's try Barkaboo as a veterinarian. Hello Better and see their financial tab and the financial information that we have on the particular venture. Of course, we have Health Tech Alpha has our proprietary analytics, looking at the venture maturity. 63.7 is above average maturity for a venture, and then the money score gives an indication of financial strength. Here, 40.8 is rather on the low side. So if we jump into financials, let's see why that could possibly be, and then the analytics that we give you within Health Tech Alpha show you exactly why that money score is a little bit below average, and that's because for the Series B that Hello Better just raised, the median is 20 million. They only raised 7.73 million, right? So that's where we see that they're not raising the same amount of funding that their peers perhaps have raised for that. We can jump into any of these funding transactions and get more information about that. And that's where you see, when did they raise their Series B funding, so you can get a quick understanding. If you jump into any venture, how long ago was their last raise, and what was the spacing, right? What was the time it took in between their funding raises? Here it was only a year or 2 months in between funding rounds. So within that year, then they needed to raise more funds. So you can expect then for the next Series C, they might need to raise rather quickly. And then funding velocity as well, it gives you how fast are they increasing the size of their funding rounds. Okay, of course, investors that you see, and again, this is looking at their peer group, understanding, because we focus on digital health, we can very quickly say who are the similar companies who do similar things to Hello Better, the Hello Better, their therapeutic focus, their cluster focus area, and then understanding what's the spread of funding transactions within that particular peer group, right? It gives you a very focused understanding of what's going on and how Hello Better compares to its peers. So
there's a question for you there from Ken, Sarah. You were on a filtered table. You're saying, where can you see the total?
The totals of particular venture funding.
No, I think it was a filtered table before that. He was asking, where can you see the total? I presume he means total funding.
The total funding for the transactions tables.
Yeah, I think so. It's not, the question doesn't say, it just says, where can I see the total? Yes is the answer from Ken.
If you need to see the total, then you can export it into Excel and get the total of that funding table. Or you could put it into, for example, a workspace, and then you'll get the cumulative look of the particular information that you're finding. Within this table itself, you're not going to get the cumulative because it doesn't really give you much information to know across the broad range of digital health how much total funding has been raised. But again, you can select your group of ventures, put them into a workspace, and then that workspace will give you the totals. Also see any question about any data about DTX funding. You can, in fact, filter the table under the primary cluster for example, digital therapeutics. That's apologies. You said that's a category that is in Health Tech Alpha.
There you go.
And then you get the digital therapeutic ventures that you have. If we want to take off the range of funding, or we could have left it on actually. This is all digital therapeutics. What we can do is export this particular list and then see what's been going on through that. What we can also do, Michelangelo, is go and do a general venture search, get out of the funding tables, do a general venture search just for Europe and digital therapeutics.
Mm-hmm.
And then what you're going to do is then export that into a workspace, right? Because the workspaces, I don't quite have time to go through all the steps here, but if I click on the workspaces, what that's going to do, let's look, for example, the digital health in Massachusetts, gives you a very specific geographic area. It'll tell you in the past 6 months, for example, how much funding was raised, how much the total, right, venture funding raised in the past, or since 2012. It gives you all those ventures, right? And then it also gives you who's been investing in the area, right? If you want to look at digital therapeutics in Europe, you see just who's investing in digital therapeutics in Europe. And then you as well have where those ventures are located and the total funding distribution by year. Right, so that's the advantage of the workspace. It's a very powerful feature of Health Tech Alpha. Of course, that's all powered by the fact that we have more than 14,000 digital health ventures categorized across the globe, and which is the largest digital health database that you will find. See, what other questions do we have? Now,
there's Ken asked a second question there, which says, did you do any analysis? I know the answer is no, but you can probably more talk about how you could quite easily do it on a distribution of investment by corporate ventures versus traditional VC. I presume he means corporate CVC type investment versus VC, but I'll let Ken clarify.
Yes.
So CVC versus non-CVC, look at it that way. Unless Ken corrects us, then correct, that's his question. So, can we do CVC versus VC? And see how that trends differently, or not for that matter.
Within the workspace, you do get the top investors, so you can get an idea of, okay, which of those top 10 are the CVCs and which are venture capital firms, traditional venture capital. Or if you go to any of the, you can search by the investor in particular, right? And look at which investor is doing which type of investing. So that's definitely possible. Of course, if you go to the corporate, it shows their CVC arm as well as their partnering. So we do keep them separate, right? If you look at, for example, Bayer, you won't see everything under just Bayer. You'll have it split out into their CVC as well.
Cool. Yeah. So in short, I guess, Ken, the analysis is very feasible. We haven't done it for today, but the analysis is very feasible, and it's. I can see where you're going, which is, is there a difference between VCs current cautiousness versus CVC, particularly pharma CVC, for example, which has a ton of cash to deploy, and therefore we're seeing different behaviors there. So interesting question. And hopefully, Michelangelo, you get a sense that your question around data on DTX funding, there is loads of it. You create a workspace the same way we showed you the Massachusetts analysis, and then you can deep dive in that data and cut it and slice it by geography, by therapeutic area, by where the product's been launched and not launched. I mean, you can cut and slice this thing any way you want, really, and get a real good sense of what DTX across the planet's doing. And I guess that question is probably closely linked to pair therapeutics, or linked anyway somehow to the demise of pair therapeutics. Any other questions? Because I'm conscious of the fact that we've reached the time commitment for the analyst briefing, but in sum, I really wanted to share with you how we are looking at funding at the moment. At a high level, of course, we do get into the detail with all our clients, but at a high level, I wanted to share with you what's keeping us concerned and what we are regularly monitoring. We check in on this quarterly on the public in what we publish. So the next time you'll hear from us in relation to funding strength will be at our half-year point, where that will always coincide as well with our usual mid-year reporting on each of the regional ecosystems. So that'll be Asia Pac, Middle East, including Israel, Europe, North America, South America, where we'll be actually looking at how each one of those regional systems has performed in the first 6 months, of 2023, which I suspect will make from some fascinating reading.
Yeah, we also include funding strength, Julia, on any of our thematic reports. We publish thematic reports every month. So if you're interested, you can go to healthtechalpha.com or go galengrowth.com to our research page and see the different thematic reports. Most recently, we published last week a report on oncology. And coming up, to give you a small teaser, we will be looking into cardiovascular diseases. So those specific areas, we will look directly at the funding strengths there.
Correct.
You can create your own free healthtechalpha.com account and download up to 5 reports free of charge with a basic account. So we highly encourage you to do that.
Yeah, and as you just said, so oncology is our most recent hot off the press, published very recently, and really looks at how oncology, which has been, I think, one of the key drivers of maturity and scaling in digital health over the last few years, how has that formed and what type of innovation we're seeing bubble through in the oncology space. So heartily recommend that report as well. It's our usual 70+ pages of data driven analysis, no hype, no bias, no favoritism, literally just looking at it nuts and all. I think we're done on questions. So yep. Ken wants to understand the relative funding strength. We do too, but you can no doubt do some of the analysis in your own time, Ken, using the platform through normal access.
Absolutely.
That's it, I think, Sarah.
Yeah, thank you all for joining. It was a pleasure. If you have any further questions, you can send us an email. All the data powered by Health Tech Alpha. We look forward to seeing you at the next webinar, or analyst briefing, as we like to call them. Take care. Have a good day.
Thanks, everyone. Thanks for your questions.